This content should not be construed as financial or investment advice. I am simply sharing my personal views and perspectives, which I hope will educate and inform and help give you the confidence to make your own financial decisions. If you need financial investment advice, please seek in-person advice from a qualified, experienced, and regulated finance professional. YouTube will not save you.
Hello, I'm the Fourth Accountant, and today we're going to cover a video by Damien Talks Money about how to avoid personal income tax. Now, there are plenty of videos about this topic, and it does seem to be a rite of passage for many financial influencers on YouTube. So as I say, this is a video, or this topic is something I've seen many times. But I did think I wanted to cover this by Damien Talks Money, mainly because I find him to be a very credible YouTube creator. He gives a lot of excellent advice with respect to personal finances and investments. And I have recently covered a video of his where he covered the SpaceX IPO, which is an excellent video. And I'll leave a link for that video, as well as this one I'm reacting to. But in terms of avoiding wealth tax legally, and apparently he's going to give us 18 ways of doing this, what I would, strongly warn anyone who, consumes this kind of content is that the UK has a principle-based approach with respect to application of tax legislation rather than a rules-based system. And what I mean by that is that they look at the spirit of what people are doing, and they take a very dim view regarding what they perceive to be aggressive avoidance. So even if something is legal, they may look more closely at people's tax planning arrangements if they feel it's too aggressive. And if there is no case law covering what should happen, so if there's no legal precedent around what the tax application or the tax interpretation should be, then they will take that person to court and challenge their tax arrangements. And if they win, they can go back 7 years to then recover any taxes they feel are due once the legal position is clarified. So what I'm basically outlining here is that when it comes to avoiding tax legally, it's not a simple case of one size fits all, and it's not a case of avoiding by numbers. So when you consume any of this content, it's best to take it as infotainment and just to help inform any discussions you may have with a tax advisor or a financial advisor in real life, in person, that understands your circumstances, understands if there's any applicable case law and whether that's been tested or not, and then can help you manage risk around what you're choosing to do to legally avoid tax. Because as I say, you have to consider case law, and case law is where there can be this gray area in terms of what you're doing and it being on the right side of tax avoidance or slightly shifting over to the illegal space of tax evasion. So with that in mind, we will dive into this video and see what we can learn.
I've got 18 simple, effective, and legal ways that you can reduce your tax bill and make yourself more tax efficient.
Yeah, and all of these things you can see on the screen here. If you go onto Gov.uk, these will all be things you can look up for yourself, right? But I guess the key thing here is that the UK tax system is very old, it's very convoluted, and very complex. And my own suspicion is that it allows the government politically to say they're increasing taxes, but allow ways of people to also avoid taxes if they're knowledgeable enough and have the resources to take advantage of the complexity.
Pensions are weapons of mass tax avoidance. You should be paying into one. If you're employed, self-employed, whatever. If you're employed, maximise the employer match, use salary sacrifice if it's available to you. And most importantly, don't let politicians scare you off. Pound for pound, a pension is the best vehicle for saving for retirement because it's literally what it was designed for. ISAs are flexible products, they're not designed specifically for retirement. But let's look at a few bits now around taxation so that we can really get these things cranking. Look, I go on about this one, but for good reason. 72% of eligible higher rate taxpayers don't claim it. and around 1.4 billion a year is left unclaimed, and that amount is going up every year. So are you a higher rate taxpayer? If yes, go ask your HR department or call your workplace pension provider and go, how are my contributions being paid into my pension? If they say the words relief at source, you may be able to claim. So what is going on here basically is when you pay money into your pension with a relief at source scheme, you get 20% tax relief automatically. But as a higher rate taxpayer or an additional rate taxpayer, you should get 40 or 45%. That missing bit of tax, the 20 to 25%, you should claim that back yourself. But millions of people don't know about this. No one's also telling them as well that you can go back up to 4 years. So this tax year plus the previous 3 tax years. You can do that by filling out a self-assessment or just contact HMRC. The money lands in your bank account, like a cash amount in your bank account.
Yeah, so what he's advised there is correct, and it's a well understood approach to basically getting as much tax relief on your pension contributions as possible. Now, this is not an avoidance of tax, just to clarify. This is a deferment of tax. So you get tax exemption or tax relief with respect to the contribution. But as many of you will know, once you collect pension income on the other side, that is when you'll be taxed at the prevailing rate of tax in the future.
Next up are pension contributions for a non-earning spouse. Even with absolutely no earnings, someone can still get basic rate tax relief on pension contributions up to £3,600 a year gross. That means they pay in £2,880 a year into a pension, and the provider of the pension will claim £720 back from HMRC of tax that was never actually paid. Now, on paper, it might be better to pay into the main earner's pension, especially if they're a higher rate taxpayer. But if you're already maxing out your pension, this is free money if you put it into your partner's. But even if you're not, say, over decades, it builds this separate pension pot in the lower earning partner's name, which gives you 2 different retirement pots, 2 sets of tax bands and allowances that you can draw on. It just gives you more flexibility over how you draw your income in retirement, which can be more tax efficient.
Yeah, and this approach is quite common, right? So where you are in a civil partnership or a marriage, a lot of tax planning will be around how you can use your partner's relief, if any, bandings or allowances, if any remains or if any is available. So this will be a common theme, I suspect, with much of the advice he gives with respect to married or civil relationships.
So you get tax relief today and then tax efficiency down the line. The third one is using pensions to reduce adjusted net income. The tax system is full of traps and invisible cliff edges. Earn over £50,270 and some of your income may move into the higher rate tax band. Earn over £60,000 while you're claiming child benefit and you start paying some of that back. If you earn over £100,000, your personal allowance starts to disappear. And the most brutal out of all of these, so if you or your partner's expected adjusted net income goes over £100,000, you can lose access to tax-free childcare and funded childcare support, go £1 over that 100k, and it can cost you tens of thousands of pounds. Pension contributions can reduce the income that HMRC uses for some of these calculations. That's what adjusted net income is. And it relates to pension contributions, including the relief at source contributions, the one I mentioned before where you need to.
Yeah, and this is really, really useful. And again, this is something that if you speak to your employer and your HR department, they should be talking to you about this, or they can even invite the company pension provider to talk you through what Damien has talked through here. Now, the reason why I'm pausing the video here, and this particularly irked me during the budget announcements in 2025, is that what the Chancellor Rachel Reeves has done is restricted the salary sacrifice and how generous it was. And I believe she's restricted it to about £2,000 or something like this. Whilst before, there wasn't really a limit on how much you could contribute to benefit from reducing what would be considered your taxable income through this salary sacrifice scheme. So as I say, clearly that's a very effective way of taking, maybe if you've had a bonus or you've got variable pay and you want to then put more of that into your pension, it clearly incentivizes preparing for retirement, especially if you're on a defined contribution scheme where what you're going to receive when you retire is completely unguaranteed. because it's subject to market performance. So I think for me, that is why I personally was very, very frustrated with this change to the salary sacrifice scheme, where there was a limit put on it in the interest of fairness, as far as Rachel Reeves was concerned. But all it does, in my view, is make preparing for your retirement harder, which makes what he's describing here much less effective than it otherwise was prior to the budget 2025 announcements.
So if you're hovering around one of these thresholds, paying more into your pension can save you tax, protect benefits, and build wealth all at the same time. Next up, limited company directors should be paying into one. Nice and simple, this one. If you run a limited company, you can open a SIP, so a pension, and then you can pay directly into that pension via your business.
Yeah, and this is a very old school, well understood approach of tax efficiently contributing to your pension. And it's one of the things that if you do have a limited company, you're probably already aware of anyway. And the mechanism in which you do this, you might need to seek advice from, because you can either payroll it or you can pay it directly from the company. And I believe what Damien is suggesting here is that there's a direct contribution from your company, which I believe to be the more flexible version. But again, have that discussion with your trusted tax advisor if this is something you're thinking about.
Gets money out of the company and into your personal name without income or dividend taxes. Even better, it's usually a business expense, so you can reduce your corporation tax bill at the same time. It's essentially a legal backdoor from your company into future you money.
We need to be careful here. It's not a backdoor because it's legal, right? So this is tax avoidance. It is permitted. And again, we have to think about the spirit of what is happening here. So the reason why there's this flexibility is because as a director, especially if you're thinking about a growing business, a starting business, it's very difficult to commit to pension contributions or commit to a payroll, right? So if you're a sole director running your business, you need that flexibility where cash flow is good, therefore I'm going to contribute more. Cash flow is drying up, so therefore I'm going to not contribute as much as I need. And what you don't want to find yourself in is there's these arbitrary windows that penalize you because you're in this unstable growing situation. So it's a pro-business scheme, essentially, that the government is allowing. It's well understood. As I said, this has been going on for as long as there's been businesses, to be honest with you. So this isn't, I wouldn't describe it as a backdoor. I understand the sentiment of what Damien is saying, but this is a well understood and approved, in my view, implicitly, approach you can take if you are a company director, and this is a limited company, to contribute to your pension in a way that the government wants to incentivize, right? Because otherwise, you essentially become a ward of the state, and you're then a burden on the state in terms of collecting benefits and welfare and relying on your state pension, right? So that, in my mind, we do need to be clear on that point.
And this is even more powerful if you combine it with the next thing, pension carry forward. Pension carry forward rules allow you to use any unused annual allowance from the previous 3 tax years on top of this year's £60,000 allowance. So someone who didn't pay into their pension over that period could potentially contribute up to £240,000 in a single tax year once all of the tax relief is taken.
Again, to clarify, this is absolutely correct, but as I outlined in the beginning of this video, there could be a view by HMRC if there is a perception of aggressive tax avoidance, despite the fact this is perfectly legal. And the context behind this is if your business is loss-making, and then they can see that you're basically increasing your taxable losses by maximizing your directors' pension contributions, clearly there's going to be a dim view that HMRC may take around that approach. So again, it's important that you assess what you're trying to do and the risk associated with it with a tax advisor that is familiar with case law. Because as I say, one of the things you have to consider is how profitable is your business, right? Does it make sense in a commercial objective way that if your business is only making £10,000 revenue, but somehow you're contributing through it 240k of director contributions, right? And you cannot run your business insolvently, right? You can't be, that's against the law. So again, what he's describing here is technically correct, but do appreciate that the business has to probably be able to sustain this level of contribution. Right, that's the key thing I would suggest here.
If you're full-time employed, then you typically can't pay more into your pension in a single year than your total income for that year. The rules are different for employer contributions, so that means if you're a limited company director, for example, you can get more in than your income for that year. You're only limited by the total allowance, which is why this is such a good rule for limited company directors. But that income rule reduces the potency of this rule for most normal earners. Working from home. From this tax year, the government has changed the rules around claiming working from home expenses, but you may still be able to go back up to 4 years and claim for previous tax years. For costs like gas and electricity, HMRC lets you claim either £6 a week or the actual extra amount that you've paid if you can evidence it. Now, it's a tax relief, so you don't get the full amount back. You save tax at the rate that you pay on that amount. But over 4 years, it can still really add up. Also, it's your last chance to make this full claim. The key thing is with this, right, you must be required to work from home, not just my employer lets me do Fridays at home because they're nice. More like my employer has no office, I have to work from home, or I'm required to live far away from the office. Next is mileage. If you need to drive for work and your employer reimburses you less than HMRC's approved mileage rate, you may be able to claim tax relief on the difference. The approved rate for cars went up this tax year from 45p to 55p per mile. That's on the first 10,000 business miles, but many employers are still paying only 45p. Some pay even less. Also, love the fact that you can claim 20p per mile for using a bicycle.
Yeah, so the last two things I haven't really commented on because, again, these are like the director's pension contribution. These are things that have been in place for quite some time. However, what he is rightly pointing out is that these rules can change quite frequently and they can be politically motivated as well in terms of some of the changes they make. So the key thing, as he's suggesting here implicitly, is that you stay up to date with these reliefs essentially and make sure you're checking with your employer, if you are employed, that they're applying the latest relief. And if they're not, then you're capturing that difference through a self-assessment.
Check your tax code. HMRC overcharged 5.6 million Brits a total of 3.5 billion in income tax last year, an average of £625 each. HMRC, unfortunately, is under absolutely no obligation to check this for you.
And I think I can't understate how important what he said here is. I can't overstate how important what he said here is. I personally know that, they don't get the tax code right. And it is important that you check it, ask them to explain it, and based on, what they tell you, potentially challenge it. Because ultimately it is something that will cost you money if they've got it wrong. And there's not going to be any interest when they do resolve it, right? There will be some interest, I suspect, but it's not going to be enough in terms of the opportunity lost with respect to the money that could have been in your pocket or could have been in your pension growing, right? So I think this is a really important tip. Definitely check your tax code.
Investing is our next section. And when I say investing, I mean savings and investments outside of a pension. First up, using an ISA. The first thing to say is you should be investing inside of a stocks and shares ISA before you ever consider investing inside of a general investment account. It's surprising how many people use GIAs over stocks and shares ISAs because this is probably one of the biggest tax savings you can make as an individual over a lifetime. The taxes you will pay, dividend and capital gains tax, if you don't invest inside of the tax-free wrapper, will be absolutely massive down the line. Also as well, this allows you to build this strategic tax-free pot to supplement your retirement pension income. You can draw on your pension up until a point that you start paying tax and then supplement the rest with the stocks and shares ISA potentially.
And I do agree with him here. You definitely want to get as much into your ISA as quickly as possible. And I would agree personally, for me, my preference would be to get it into the ISA before a standard, let's call it, or general account. Now, again, you've got to consider what is best for you and your own financial goals and your own financial needs. But in principle, anything that means that you're maximizing the work your money is doing, to me, is more preferential, I would argue.
The next one is offset capital losses against capital gains. At some point, every investor buys something they probably shouldn't have. It drops in value. They regret the whole thing, they sell it. Don't just sell it and try and forget about it. HMRC lets you set allowable losses against current year gains or even carry them forward to reduce capital gains tax on future gains.
And this is a really important concept. And this is part of the reason why receiving or building assets is very helpful from a tax perspective, right? So if you're buying assets and that is the main source of your wealth, and you sell an asset at a loss, it gives you future tax relief as and when you make income, right? You can't do this through earning an income, like earning a salary. There's no offset available to you. Whilst if you have assets and you dispose of an asset at a loss, it gives you future relief, right? So again, if you think about any crypto that you've had and it's gone wrong, that's a classic example where potentially there may be an opportunity to use that loss to help offset a future gain, right? So this is a very underplayed strategy, I would argue. And also the timing may be important as well. And this is where you do need financial and tax advice. It's important you use these losses strategically. So it's not just enough to say, use the loss. I think it's really good that he's raising this so that there's an awareness in your mind, but also think about strategically how you use them as well. So I hope you're enjoying the video, and please feel free to leave a comment because it's always good to hear different perspective on the topics we talk about here, and it's the way we learn. Otherwise, if you are new to the channel, please feel free to like and subscribe. In the meantime, if you are worried about your personal finances, the amount of tax you or your business is paying, or you're in a quandary around how you can scale your business by leveraging financing and accounting automation, please feel free to reach out to myself for a no obligation consultation. Otherwise, let's get back to the video.
You have to report the loss to HMRC on your tax return, and then you can claim a capital loss up to 4 years after the end of the tax year in which you disposed of the asset in which you locked in that loss. The next one is another simple one, the personal savings allowance. This isn't really a way to reduce tax, it's more a tax break people forget that they already have. So too many people shove money into a cash ISA without first checking their personal savings allowance. You can earn interest on cash tax-free up to £1,000 as a basic rate taxpayer, £500 as a higher rate taxpayer, nothing unfortunately if you're an additional rate taxpayer. Just make sure you're using that allowance before you consider using up ISA allowance putting cash into a cash ISA. Next is transferring assets to a lower tax spouse before selling. This one's a great one. Everyone has £3,000 a year annual capital gains tax allowance, but many couples keep the majority of investments in one person's name. One person uses their allowance, the other one goes to waste. Transfers between spouses or civil partners living together are usually treated as no gain, no loss for capital gains tax.
And this is what I was talking about earlier when he was discussing how you could use or make contributions with respect to the pension, right? So the same principle applies here. If you are married, from a tax perspective, in many cases, there's no distinction between you and the person you're married to. And therefore, broadly speaking, you can take it as though, okay, in this particular example here, your group allowance is actually 6K compared to a single person where it's 3K. So as he's suggesting here, what you need to do is make that transfer. And because it's between married people, that transfer is treated as a non-taxable event. And then they can therefore then dispose of the asset in question using their allowance if they have any remaining, right? So this is the key assumption here, that they themselves have not made any disposals and therefore they've got the full 3,000 available.
So you may be able to move assets to your partner before selling and both use that £3,000 allowance. This works even better if your partner pays a lower tax rate than you, because CGT is currently 18% for basic rate taxpayers and 24% for higher and additional rate taxpayers. Now the transfer must be genuine, properly documented, and between spouses or civil partners. Use gift aid properly. You know the question, would you like to add gift aid? That lets the charity claim back basic rate tax on your donation, giving them 25p extra in every £1 you donate. But if you're a higher rate taxpayer, you can claim the difference between basic and higher rate tax yourself as well. So this can either be a refund or just an adjustment to your tax code. So when you tick gift aid, keep a record. And if you pay above basic rate tax, there may be extra relief or money in it for you too.
Yeah, and that's a good one because I don't think many people are aware of how to use it if you're a higher rate taxpayer. So again, it's a very marginal gain, but every little thing counts, right? So when you take an accumulative effect of all the advice he's giving, it really will be really, really significant, right? So again, I think that's a really, really good tip not to be overlooked if you are a higher rate or an additional higher rate taxpayer.
Leave 10% of your net estate to charity. If you leave at least 10% of your net estate to qualifying charities, the inheritance tax rate on the rest of your taxable estate can fall from 40% to 36%. In some cases, that means your family might be only slightly worse off, while a charity of your choice benefits. Right, since we're talking about death, let's continue by focusing on inheritance tax now. Everyone gets a basic £325,000 allowance. And if you leave your main home to your children or grandchildren, you can also get a £175,000 residential allowance on top of that. These allowances can also be shared by couples. So that means potentially that you can basically leave £1 million tax-free.
Again, notice the pattern, right? By virtue of marriage, you're doubling or increasing or enhancing your pension contributions from a tax perspective. You're enhancing your use of capital gains allowances and potentially exposing yourself to a lower capital gains tax rate. And now with respect to inheritance tax, again, you're able to maximize or effectively double the available allowances by virtue of marriage. And again, I think these are things that are well understood, but it comes back to my original comment around the fact that the tax system is around principle and spirit and what the government of the time is trying to promote. And in this case, what they're trying to promote is the idea and the tradition of family, of marriage.
But with frozen allowances and upcoming changes that include pensions into the estate now, more and more estates over time will be pulled in. So here are a few legal ways to reduce the bill. First of all, the annual £3,000 gifting allowance. Lots of people have cash in retirement they know they're probably not going to spend, yet they leave it in a potentially taxable estate and then worry about inheritance tax. But there is an annual exemption that lets you give away £3,000 per year tax-free, and that money falls immediately outside of your estate. You can also carry forward the annual allowance from a previous year. So that means you've got £6,000 initially potentially, and then £3,000 a year every year after that. Just be a legend while you're alive, bask in the glory, and potentially reduce your AHT bill. Another one is normal expenditure out of income exemption. Some retirees are fortunate enough that they bring in more income than they spend. Instead of letting that spare income build up as taxable cash inside of their estate, they can make regular gifts that don't use up the other allowances that we're discussing right now. These gifts must pass 3 tests. They must come from income, not capital. They must form a regular payment pattern, so you must do this on a regular basis. And they must not affect your normal standard of living. So instead...
Yeah, so I'm going to pause it here. I mean, there's going to be more he's going to cover. And again, it's just to reiterate the importance of financial planning and advice. So all of these things are contingent on the fact that you have a financial plan that you can stick to and operate within, right? And clearly, implicitly, some of the tests he's described here will require that, right? So although we are armed with this knowledge, which is all available, by the way, on HMRC's website in the UK, whether it's appropriate for you or not, whether it's sustainable for you or not, whether it gives you the quality of life you would like, presumably in retirement, that is something you need to work on with a financial advisor.
Just be careful, not everything counts as income. Some insurance withdrawals, annuity payments, or care plan payments may be treated as capital and not as income. The final one is the big one, the potentially exempt transfers. So for money and gifts outside of those allowances, the final method is simple. Give it to a loved one and then don't die for 7 years. These are called potentially exempt transfers, or PETs. If the donor survives 7 years from the date of the gift without dying, it's usually free of inheritance tax. But even if you die within the 7 years, the IHT position works on a sliding scale as shown here, so you don't pay the full amount. But if you die within that 7 years and you've given an amount below the allowances that we discussed before, they will take that amount in full off the allowance before they calculate the IHT bill. So no taper relief is applied. In a way then, if you're giving before death to reduce IHT, it is sensible to give as much as you can because the taper relief only applies after that allowance is exceeded. Clip that out, send it to your parents and thank me later, guys. Use your marriage allowance. If your partner has income below the tax-free allowance of £12,570 a year and the other one of you is a basic rate taxpayer, they can transfer £1,260-ish of their allowance to the higher earner via marriage allowance. That potentially saves you up to £252 a year, or whoever the person is earning in that relationship. You can also backdate that claim for up to 4 tax years. This is another one of those tax breaks that you can do a chunk of at once, and then you can do it every single year going forwards. And this is one of the most unclaimed tax breaks in the UK.
Yeah, what I'd flag about that last one, ironically, is that I think the phenomenon of fiscal drag, whereby the banding, the personal allowance banding of 12,570 stays the same, but wage inflation goes up, will mean less and less people will be able to take advantage of that relief. So if that's something that applies to you now, definitely look into that and maximize it as much as you can and go back as far as you can to do so. But one would argue, who does that actually cover these days based on the cost of living now? So yeah.
It's worth saying that the whole point of this video is not because I hate tax, it's not because I think people should avoid all the tax they can, and it's certainly not to be shady. It's just to help people understand the rules, because there are millions of Brits leaving money on the table that is rightfully theirs.
Yeah, and we're going to leave it there. And I do agree with this sentiment, to be perfectly honest with you. So again, I am not somebody who believes necessarily in low taxes, but that for me is just more a personal position with respect to, I would like to see, for example, a welfare state. It's something I've benefited from, and I think it's good to give that platform to children who are born into situations that they have no control over. However, the key reason and the key sentiment I believe behind the advice he's giving, and it's the same reason I would also give this advice, is because we want to see a level playing field, right? So if the view is that we want to see a low tax economy across the board, so if you think about, the very, very wealthy and the ways they're able to avoid tax, then my own personal view, and my suspicion is Damien's view, based on what he's just said, is that we want to see everybody benefit from this low tax arrangements, right? So essentially it's about equitability and equality under the law, as Gabriel Zucman has recently outlined, who's a famous economist in France. And again, that would be my own view. If it's good enough for those that are earning lots and lots of money, then the rest of us can follow in those footsteps. However, if we want to see high taxes and people make higher contributions, then everybody in society should be required to make high contributions as well. So that is kind of the way I see things. But ultimately, this is a really, really informative video. A lot of these things you can consider and can apply. And as I say, much of the information, if not all of it, will actually be available in HMRC's own guidance. So again, these are not shady things. These are not things HMRC is hiding from anybody. This is not backdoor tax evasion. And there's much more sophisticated things you can actually do, and the very rich are actually doing, if you want to be very, very aggressive about basically avoiding all taxes, right? The key thing is to stay informed and to take this information, I would suggest, and have those conversations with a bona fide, experienced tax expert who has very, very good knowledge of tax case law. So on that basis, I hope you found things useful. But until next time, peace.